Well, hi, everybody. I'm Rick Edelman. Thank you for joining us for this rather surprising and unexpected webinar. If you'd asked me a week ago, I would have said there's no way that we're going to talk about Ethereum ETFs anytime soon. And yet here we are. So we're going to talk about why and what's going on and what it all means for you and what the opportunities are and the risks as well, of course. And so I'm glad you're here. We've had hundreds and hundreds register for this event in just 48, 72 hours. And so I'm really excited that you're here to talk about this. We're going to have a lot of time for a lot of Q&A. Get ready for all of that with your questions. You can enter them into the Q&A box in the chat here on Zoom. And we're going to just tackle as many of them as we possibly can. Don Friedman, the president of DACFP, will help curate all of those questions for us so that we can get to as many as we possibly can. So let me just jump right into it. This is a webinar to introduce you to the new spot Bitcoin ETFs. I'm going to talk about them, of course, but I want to meander a little bit because we need to put Ethereum and these new ETFs into a bigger context. And that's because it's the context that has led to these new ETFs getting approved. And this backstory will really help you in understanding the bigger picture and also in your conversations with clients to understand what all this is about. To make a short story long, we've come a really long way since Laszlo Henjes paid 10,000 Bitcoins for a couple of pizzas. Remember back in 2010, Bitcoin Pizza Day. Bitcoin's blockchain now processes 750,000 transactions every day, a big increase from that one back on May 22nd of 2010. Bitcoin's market cap is now bigger than Facebook and Berkshire Hathaway's, Eli Lilly, JP Morgan, Visa, Walmart, ExxonMobil. Bitcoin's bigger than all of them. But Bitcoin has some significant limitations. We all know that its price fluctuates a lot. Since 2017, the average daily price movement is about 3%. That's pretty remarkable. That's 3 times more than the S&P 500. So Bitcoin is volatile, and we all know that. Now, this makes Bitcoin a great store of value because the price volatility has generally been up, not down, making Bitcoin the best performing asset in history. But while it's a great store of value, it's pretty lousy as a currency. Bitcoin also has another problem, and that is the fact that it takes 7 seconds to process, to verify every transaction. In those 7 seconds, Visa processes 12,000 transactions. So scale's an issue for Bitcoin. And the biggest problem, of course, for Bitcoin is that it processes its transactions immediately. But you might not want that to happen. I mean, think about that. When you give money to somebody, it's usually because they did something for you. You know, you buy an ice cream cone and they hand you the cone, you hand them the money. Sometimes we have to pay in advance, and that always makes us nervous. I mean, if we buy a dishwasher from Home Depot, we can be pretty confident that they're going to deliver it. But sometimes settlements aren't so confident. You know, you ever have a real estate contract go bad? Some contracts are even based on unknown outcomes, you know, like the weather, or who's going to win the game, or will there be a move in stock prices or interest rates. I'm talking about conditional transactions, and these are the basis for pretty much every legal contract in the world. And Bitcoin can't help you with any of that. Can't help you with any of that. If you have an if-then transaction, if you do something, then you get my money. Bitcoin doesn't work because if you send me your Bitcoin, I receive it almost instantly. So if you only want me to get your money after you get what you were promised, Bitcoin is not terribly helpful. And that is what brings us to Ethereum. Yeah, I told you we would eventually get to Ethereum. Ethereum was invented in 2015. You might have heard the phrase programmable money or smart contracts. That's Ethereum. And it's called this, programmable or smart contract, because you can program the coin to control the timing of when and why your transmittal occurs. This is a really fundamental feature to Ethereum, and it's totally different from Bitcoin. And this is hugely useful in business. And that is why Ethereum is now the second largest digital asset by market cap. Ethereum is about 500 billion in value today. Bitcoin is 1.3 trillion. Between the two of them, Bitcoin and Ethereum, they are about 90% of the entire crypto market. In other words, they're the Coke and Pepsi of crypto. So yeah, you can buy Dr. Pepper if you want. Go ahead, knock yourself out. But you want the Coke and Pepsi of crypto? It's Bitcoin and Ethereum. Some of the biggest brands in the world are building projects on the Ethereum blockchain today. Nike, Starbucks, Louis Vuitton, Burberry, Tiffany, the list goes on and on and on. Ethereum is also the primary platform for stable coins and DeFi, decentralized finance. Each of those markets are about $150 billion apiece. There are two other important differences that I want to mention about Bitcoin and Ethereum. One is their protocol. Bitcoin operates on a proof of work protocol. That's what Bitcoin mining is all about. We have to prove that the transaction is legitimate, and we prove it by doing a complex computer calculation. We do a lot of work. That's why it's called proof of work. And when we verify that transaction, it produces new coins. The Bitcoin mining process leads to the mining of coins, and those are called a mining reward. And that's how Bitcoin operates. But Ethereum doesn't work that way. It used to be a proof of work coin, but they shifted a couple of years ago to a different protocol called proof of stake. And proof of stake means that you are going to stake your coins in order to win more coins, and it's more like a raffle ticket than a mining operation. The point of it all, though, is pretty cool. With Ethereum being on a proof of stake platform, it means you can generate yield when you invest in Ethereum. Bitcoin doesn't generate yield, but Ethereum does. So what it comes down to is that Bitcoin is inflation proof. There will only ever be 21 million of them. So far, there are about 19.4 million that have been mined. The rest will get mined over the next 160 years. Yeah, 2140 is when the last Bitcoin gets mined. This makes Bitcoin inflation proof, and it's a big reason why Bitcoin is considered such a good store of value. But Ethereum doesn't operate in the same way. It doesn't have a fixed supply. The quantity changes. Lately, over the past year or so, the number's actually been going down as a result of the staking. I'm not going to get into all the details here. We have complete courses on Ethereum and staking and the proof of stake protocol, et cetera, which I'll talk about more later. But bottom line is, we benefit from getting yield, but it also means we never really know exactly how many Ethereum there are going to be in the future. There could be more, there could be less than the current amount. With Bitcoin, though, we always know exactly how many Bitcoins there are. And so that all brings us to the new spot Bitcoin, spot Ethereum ETFs. Yeah, it is a webinar on the spot Ethereum ETFs. I told you we'd eventually get here. Here we are. There are 8 of them, 8 of these Ethereum ETFs that were approved by the SEC last Thursday. Bitwise, Fidelity, Franklin Templeton, Invesco Galaxy, and BlackRock are among them. We also have Van Eck and ARK. The same ETF providers that created the Bitcoin ETFs are now going to offer the Ethereum ETFs. Standard Chartered, big bank in England, predicts that these new ETFs are going to generate inflows of about $45 billion in the first 12 months. That's nearly the same pace as the new Bitcoin ETFs, a little bit less, but still pretty amazing, $45 billion if they hit that number. But we can't buy these ETFs yet, and that's because the SEC has totally messed up this entire process. The dysfunction at the SEC and the White House has been astonishing. And so I need to back up a little more. I need to give you a little more context here. So let me do a little more meandering for you with a little bit more of the backstory, because this will be helpful to you. We all know that the SEC approved the spot Bitcoin ETFs just 5 months ago, and that the SEC only did that after a court ordered them to do so. The court order was clear. Since there are already Bitcoin futures ETFs, they've been available on the market for years, the court said that the SEC cannot reasonably deny Bitcoin spot ETFs. And yet the SEC did so anyway, and the court said that the SEC's denial had acted arbitrarily and capriciously, and the court ordered the SEC to change its decision. So Gary Gensler's back was against the wall, and he finally approved the Bitcoin ETFs, grudgingly. But even after that entire saga, Gensler has been dragging his heels with the Ethereum ETFs as well, even though it's been clear to everybody he has no choice but to approve them. I mean, there have been Ethereum futures ETFs for years, just like there were Bitcoin futures ETFs. So why the holdup? Well, everybody was wondering, was Gary Gensler going to reject these ETFs again, the way he was rejecting the Bitcoin ETFs, forcing the crypto community to file more lawsuits just to repeat this entire escapade over and over, which would have the result of just delaying the inevitability of these products? It's all been really very frustrating for the crypto community. Anyway, the applications for the Ethereum ETFs were filed. The clock is ticking. The SEC has a statutory deadline. There's a 240-day clock from when the application is filed. And the first deadline for the very first application, VanEck, was May 23rd. So the SEC had to say yes or no to this application by May 23rd. Now, we saw when the SEC said yes to the Bitcoin ETFs, they said yes to all of them all at once. They didn't just say yes to the very first application deadline. They said yes to everybody simultaneously. And so everybody was pretty confident that when the SEC rules, they're going to rule on everybody all at once, yes or no. And the attitude was, May 23rd is approaching, they're going to say no. And the reason everybody thought that the SEC would say no was because there hadn't been any movement on these applications by the SEC for months. See, normally when a fund company files an application to launch a new fund, there's a whole lot of dialogue between the SEC staff and the applicant. But with these Ethereum ETFs, there was crickets. The SEC was saying nothing. There were no meetings, no phone calls, no emails back and forth. There was just nothing going on. And so the only conclusion that everybody was able to reach was that since the SEC was not engaging with these applications, the SEC was obviously simply going to reject them. That was the consensus pretty much for everybody, all the way up to about 72 hours before May 23rd. Suddenly, out of nowhere, the SEC started engaging with the ETF sponsors. There were a lot of back and forth requests for amendments on the applications, a lot of engagement. Suddenly, everybody's scratching their heads like, what's going on? Is the SEC about to approve these after all? What's happening? What has caused the SEC's change in sentiment? Well, as we all now know, the SEC sure did have a change in sentiment. The SEC asked for amendments to the applications, and then very late last Thursday, like around 6 o'clock in the evening, the SEC announced approval of all 8 of the applications right before Memorial Day weekend began. Was that part of Gensler's game to make everybody think that he wasn't going to move forward? And then he finally did so at the 11th hour, just as everybody's going on a 4-day vacation, so nobody knows it's coming. Everybody's flat-footed, so Gensler's not letting anybody prepare. I mean, this was so late that the SEC wasn't even able to complete its own work. I mean, yeah, they got the 19B filings completed. That allowed the SEC to vote yes on May 23rd, but the S1s have not been completed. And without the S1s, the ETFs cannot trade. So as of right now, even though everybody is running around the country saying, oh, the SEC approved the ETFs, as of right now, you still can't trade them. It's going to take another several weeks, maybe as much as 3 months, to get the S1s completed so that the ETFs can actually launch. This is no way to run a country. This is ridiculous. Can you imagine anybody, anywhere, in any other situation coming up with somebody, nobody knowing about it, nobody having any anticipation that they're going to be getting approval until suddenly, miraculously, unpredictably, it's suddenly available. This is really rather crazy. So why did it happen this way? Well, there's been a lot of scuttlebutt about that. The word out on the street is that the Democrats were getting a lot of political pressure to get Gary Gensler to approve these ETFs. See, we all know that Gary Gensler is not a fan of crypto. He's been obstinate ever since he got the chair 3 years ago. He's been hauled into Congress, I don't know how many times, to explain himself. There was even a bill sponsored in Congress to fire him over this. Virtually every former SEC commissioner has blasted Gensler over his handling of crypto. The financial services industry is not happy about it. The investment industry is not happy about it. Certainly the crypto community is not happy about it. Neither is the financial trade press. But Gensler has been steadfast in his opposition. If a court had not ordered him to approve the Bitcoin ETFs last summer, we wouldn't have Bitcoin ETFs either right now. So what suddenly caused Gensler to approve the Ethereum ETFs with just 72 hours to go to the deadline? Well, here's the scuttlebutt. Over the last few years, the crypto community has realized they're not getting anywhere with the regulators or with Congress. No new regs, no new laws. So they got together and they have formed a bunch of PACs, political action committees. And so far, they've raised about $200 million. And they've been using that money in the past several months to support congressional candidates that support crypto. And more importantly, they've been targeting members of Congress that oppose crypto. They've already succeeded in getting one Democratic candidate for the House to lose in the primaries. She actually cited the crypto community as the reason she lost her campaign. And now the PACs are targeting a dozen other members of Congress who are in very tight races. And while all that was going on, the banking committee or industry has started getting vocal. They see the Bitcoin ETFs and how they're doing. I mean, these Bitcoin ETFs are now holding $60 billion in assets. That's a lot of money. And the banks want in on this party. But they're not allowed to custody crypto under current banking regulations. So not only is the crypto community starting to beat up on Congress, now the banks are too. Hey, if you're a member of Congress, you might choose to ignore a crypto hedge fund, but you're not going to ignore Goldman Sachs or B of A or JP Morgan or Wells Fargo. Add it all up. Congress is suddenly getting inundated about crypto, and not just by the crypto community, but now by the banking community and the investment management community. And so, yeah, the Democrats, which have long been crypto haters, led by mostly Elizabeth Warren and Bernie Sanders, supported by President Biden, the Democrats have now all started paying attention. Chuck Schumer, a Democrat, who's the Senate Majority Leader, he happens to also be the senior senator from New York, the home, of course, of Wall Street. And the word is that he's been getting pounded in closed-door meetings. The message has been clear. If the Democrats continue to oppose crypto, then they run the risk of losing control of the U.S. Senate in November. So Schumer went to Biden, who has spent the last 2 years trying to kill crypto. Remember, it was Joe Biden who appointed Gary Gensler as chair of the SEC. Not only that, Joe Biden put in a budget proposal to Congress last year and again this year that he wants to assess a 30% excise tax on Bitcoin miners. If that tax were to be enacted, it would immediately kill mining in the US. And all those Bitcoin miners and all those thousands of jobs would leave the United States and go overseas. There's Bitcoin mining now in 41 states. This would be a big political and economic impact if that tax were to get adopted. So clearly, Biden has been trying to kill crypto. So Schumer went to Biden and told him to get Gensler to change his tune. Bam, at the last minute. To everybody's surprise, the SEC suddenly, unpredictably, said yes to the Ethereum ETFs. I guess that's how politics works. Money talks, and crypto is all about the money. Crypto's market cap is now $2.5 trillion. The Bitcoin ETFs have generated tens of billions of new assets in just months. The Wall Street crowd and the banking crowd finally realize there's a lot of money to be made in managing crypto, and they want in. So suddenly, a whole bunch of Democrats who have been opposed to crypto are changing their tune. So things are happening really fast right now. Not only did the SEC approve the Ethereum ETFs on Thursday, but the very next day, last Friday, the House passed FIT 21, the Financial Innovation and Technology for the 21st Century Act. I love how they come up with these names. The bill takes the authority for regulating crypto away from Gary Gensler and the SEC and hands it to the CFTC. That shows you how angry Congress is over Gensler's handling of crypto for the past 3 years. And here's the crazy part. 71 Democrats in the House voted for that bill. It's the first time crypto legislation has ever gotten such strong Democrat support. President Biden says he doesn't really like the bill, but he hasn't said he'll veto it. So now we're all waiting to see what the Senate does. Remember, the Democrats control the Senate. As you can imagine, Gary Gensler strongly opposes that bill because the bill makes him powerless over crypto. But everybody else loves the bill. The bill sets rules for regulating the U.S. crypto markets. It establishes the consumer protections a whole lot more clearly than we have now. It even defines better whether a digital asset is a security or a commodity. In the crypto community, we've all been asking for this rule for years, but Gary Gensler has refused to write any rules about crypto. Congress finally got so fed up, they did it themselves. Now it's up to the Senate, and we're going to see if those crypto PACs have enough money and influence to get the Senate to pass the bill. Bottom line is this. The SEC's approval of the new Ethereum ETFs and the House's passage of FIT 21 clearly show that the Democrats and the White House, they finally realize that their anti-crypto stance is not resonating with the American public. A third of Americans now own Bitcoin. A third of Americans in recent polls say they're going to consider crypto when they vote. So clearly the Democrats are on the wrong side of this issue. It's now a campaign issue, and it can't be ignored anymore by the politicians. And the contrast could not be more stark between the Republicans and the Democrats. Donald Trump has pledged to support the crypto industry. He now even accepts campaign contributions in crypto. He's been giving speeches lately blasting the Democrats over their opposition. So that's the backstory. And I shared all that with you just really to make one basic point. Crypto clearly is now mainstream. 5 years ago, people used to ask if Bitcoin might fall to zero, if the government might ban it. Nobody asks those questions anymore. Bitcoin's not going away because the financial services sector is now embracing it, and that means the government has no choice but to embrace it as well. And that means you really need to understand these new investments. So let's get right to it. I promised that we eventually would. Here are the key questions that you need to ask as a financial advisor, or as frankly as an investor too. Should you invest in the Bitcoin ETF, or should you prefer the Ethereum ETF, or should you do a combination of the two? And if you do invest in both, should you invest 50-50, or should you overweight one in favor of the other? Well, here's how to help you decide. We've already talked about the differences between proof of work and proof of stake, about the fact that Bitcoin has a fixed supply, Ethereum does not. Bitcoin is largely considered to be a store of value. Ethereum is more useful as a tool for global commerce. So decide, with all those features, which of them matter more to you? Which do you think matters more to the investing community? Which matters more to global commerce? Frankly, it's a tough call. Bitcoin is at the moment 3 times bigger almost than Ethereum. So do you choose size? I'm a fan of diversification. I think most advisors are. I'm not sure it makes a lot of sense to bet on one versus the other, but that's up to you. Personally, I believe in doing both. One thing to keep in mind, there's not a whole lot of difference when you buy Bitcoin versus a Bitcoin ETF, because a Bitcoin ETF owns Bitcoin. So Bitcoin ETF, pretty much the same thing. But when you buy an Ethereum ETF, there is a difference between an Ethereum ETF and Ethereum. There's only one difference. You can't, with the ETF, you can't generate yield. See, that staking that I talked about earlier is a way for you to generate yield, income on your Ethereum. But you can't generate yield with the ETFs because the SEC will not allow the ETFs to engage in staking. At least they're not allowing it yet. We'll see if they change their tune in the future. So that's one difference. If you're thinking that you might want to engage in staking, then the ETF isn't going to help you. But that aside, Ethereum versus an Ethereum ETF are the same thing. And keep in mind that if you do want to buy Bitcoin, if you do want to buy Ethereum, these ETFs give you the easiest, the safest, and the lowest cost way for you to do it. But like I said, if staking is something you want to do, then you got to buy Ethereum a different way. And there are a lot of other ways to buy Ethereum, not just buying Ethereum directly at an exchange like Coinbase, but there are a lot of crypto SMAs now. Yeah, separately managed accounts that allow you to do crypto. Eaglebrook Advisors is the biggest, oldest of those crypto SMAs, and companies like Bitwise and Franklin Templeton, they offer crypto portfolios through an SMA that allow you to customize doing this where you can do staking. So answer these questions. Which of the ETFs are you going to recommend? Are you going to choose Bitcoin, or are you going to choose the Ethereum, or a combination of the two? There are 9 Bitcoin ETFs. There are 8 Ethereum ETFs. Which among them are you going to pick? And how do they compare? I mean, that's how you have to figure it out, right? How, you got 9 Bitcoin and 8 Ethereum ETFs. How do you compare them? Well, we got the help for you. We've created, and we're launching it right now with this webinar, our new Ethereum ETF toolkit. We created this toolkit when the Bitcoin ETFs got launched back in January. That toolkit has proved to be incredibly popular and really, really helpful. And we have now just launched an Ethereum ETF toolkit as well. I'll give you the QR code later on in the podcast today so that you can download it for free. And that gives you in that toolkit, it gives you a grid that is a really simple and easy comparison chart that allows you to compare side by side all the different ETFs. I have to warn you about that grid. Because the ETFs haven't launched yet, a lot of the data is not yet known. So we're going to be updating the grid pretty much every day until the ETFs get launched, because they're going to be giving us new info, such as what's their expense ratio. None of them have even announced that yet. Who's their surveillance partner? Who's their custodian? None of them have made those announcements yet. So we'll be updating our grid, and you'll be able to stay current with it as we complete all that comparison charting for you. After you decide which of the ETFs to use, you have to decide which of your clients to give them to and what allocation you want them to have. Now, here's what's interesting. The Bitcoin ETFs have been around for 5 months. You may have already allocated client assets to them. Let's say that you put 2% of client portfolio into Bitcoin ETFs. Now the Ethereum ETFs have come along. Do you want to allocate to them too? Okay. Are you going to allocate 2% to the Ethereum ETFs? That'll give you a total of 4% in crypto. Back in January, was it your intent to do 4% in crypto or just 2%? In other words, are you going to double your crypto allocation, adding to Ethereum onto the Bitcoin, or are you going to cut your Bitcoin allocation in half? If you do that, that means you're going to sell half of your Bitcoin, and that means you're going to hit your clients with short-term capital gains. So you got to figure that out as well. And then you got to figure out, how are you going to communicate your recommendation to clients? And how are you going to respond to their questions and objections? My recommendation is that you allocate to both of these ETFs, the Bitcoin and the Ethereum ETFs. It's up to you to decide the weighting. Now, I would simply say this: unless you're really well-versed in this space, and unless you can really clearly articulate why you prefer Bitcoin over Ethereum, I think you should probably just do 50-50 and rebalance periodically. Now, if you're deep in the space, if you're experienced, if you're knowledgeable enough to be able to explain to somebody why Bitcoin belongs with a heavier allocation than Ethereum, or vice versa, I think you should simply be 50-50, call it a day. Now, for each of them, for the Bitcoin ETFs and the Ethereum ETFs, my recommendation is that you pick 2 or 3 of each. 2 or 3 of the Bitcoin ETFs, 2 or 3 of the Ethereum ETFs. Now, that might seem a little silly. These are, after all, single asset investments. All 9 of the Bitcoin ETFs are all doing the exact same thing. They're buying Bitcoin. And all 8 of the Ethereum ETFs will do the same thing as well. They're all going to buy Ethereum. So why bother owning more than one? Well, it's because there are differences between them. They will have different custodians, different surveillance partners. Their cash holdings will vary. Their fee will certainly vary. And they will all have a different claim to fame. For example, some of these ETF providers are among the biggest in the industry. BlackRock, Fidelity, Invesco, Franklin Templeton. Others have a very deep level of expertise in the crypto space, such as Galaxy and Bitwise. Some argue that they can check both boxes. So there are some differences between them, unique features or value propositions. I think you should choose 2 or 3 from each category of Bitcoin and Ethereum where they are truly different, to again broaden the diversification a little bit, and also to demonstrate to your client that you're giving this actually some thought, as opposed to just blindly picking one by throwing a dart on the board. As for the allocation, I would recommend somewhere between 1 and 2.5% of client assets into each one, meaning between the combined Bitcoin and Ethereum, 2 to 5% of the portfolio, and it's your choice. If you have model portfolios, there are a lot of advisors who do this, and we've always done that at the firm I created. And I'm always been a big fan of model portfolios. It's a whole lot easier to manage a practice that way, and it's, I think, better off for the client too. If you have model portfolios, let's say that you have a 60-40 model, I don't believe that you should simply add crypto to that model, because that means suddenly, instantly, every client who owns the 60-40 model is now going to immediately get the crypto. That isn't necessarily something that you want to have happen. You might not want every client to get it. Not every client might want to get it. So what I recommend you do instead is that you take your model portfolios and create clones of them. In other words, if you have a 60-40, keep it, don't touch it. Go create a clone that is 58, 40, and 2. The 2 being 1% Bitcoin, 1% Ethereum, for example. This way, you can say to a client, if you want crypto, or if I think you ought to have crypto, here it is as a very close cousin to the existing portfolio you've had. But this way, you don't have to disrupt the clients who you don't feel ought to own crypto or who themselves don't want it. So I think creating clones will be an easier way for you to manage the practice and serve your clients. After you allocate, you need to rejigger your balancing triggers, because, like we talked about earlier, crypto is very, very volatile. 3% movements daily. If you don't alter your rebalancing triggers, you could find yourself rebalancing several times a day, let alone a week or a month. And that'll cause havoc for you, your trading activities, your clients with tax reporting, and it's a mess. So you need to alter how you're going to rebalance a portfolio that features crypto. And once you've done all that, then simply manage the portfolio normally. Rebalance, dollar cost average, tax loss harvest. It's, all kind of routine at that point, because crypto is just another asset class. So with all of that behind us, I see that we've already got some folks who have asked some questions. So I'm going to invite Don to join us. Don Friedman, the president of DACFP, who for a couple of decades was the co-founder and COO of Inside ETFs and ETFs.com. Big, huge background in the ETF space. So very apropos that we're talking about ETFs here, Don. Thanks for joining us. Don, by the way, is at Consensus right now in Austin, where I'm going to be joining him later tonight. I'm jumping on a plane as soon as this is over to prep for our own Vision Conference, our biggest crypto conference of the year. I'll talk a little bit more about that later. But Don, good to see you.
Glad to be on, Rick. So to your point, we've gotten a number of questions. You talked about the allocation between Ethereum ETFs and Bitcoin ETFs. Having said that, do you feel that advisors will be as inclined to invest in Ether ETFs as Bitcoin ETFs?
Not initially. It's kind of funny as the consensus was that the SEC was going to deny these ETFs. The crypto community was largely shrugging its shoulders at the expected denial. Actually, some were actually kind of happy about it because the attitude was that the Bitcoin ETFs are still so new and so many advisors are still engaged in the due diligence process on those ETFs. I mean, all the wirehouses are still doing due diligence. None of them have blanketly opened their doors. Some of them have put the ETFs on their platforms on a receptive basis, but not on an outgoing basis, meaning that the client wants it, they'll give it to them, but the advisors are not yet able to actively recommend. And they're doing their due diligence still. A lot of advisors, frankly, have been ignoring Bitcoin up until now because most advisors use ETFs in their practice. And with the absence of an ETF, that meant they weren't going to do crypto. But now that the ETFs are here, the advisors are racing to figure out what is Bitcoin? How do these ETFs work? What's the investment thesis? How do I explain it to my client? They're still doing all that. And all of a sudden, now they're getting bombarded with Ethereum too. So I think that it's going to be a little bit of a slower uptick. But at the same time, I think advisors are going to race to realize that, oh my goodness, the crypto world is not all about Bitcoin. We believe in diversification. Bitcoin was a single asset ETF. Now we have a choice. We now have the Pepsi to add on to the Coke. So now I think the race is on. So I think that eventually, long term, you're going to see equal adoption. Some will choose one over the other or have a higher weighting than the other. But on average, I think you're going to see close to 50-50 or it'll be 60-40. I don't think it'll be 80-20 or 90-10 favoring one or the other. So I think that in the long run, it'll be there. I think as an advisor, if you were to start talking to your client about Ethereum, you'll be a step ahead. You'll be ahead of the competition because they're all still stuck talking about Bitcoin. So I think you talking about the Ethereum ETFs is really talking about the latest and greatest. So I think that smart advisors are going to be engaging in this pretty quick.
So you touched on wirehouses. So this is actually a three-part question. When do you think the wirehouse channels will be allowed to purchase these ETFs?
Well, it's like I said, they're all racing to do due diligence. Just to understand how the game is played, wirehouses are slow to adopt. They are always very focused on consumer protection, and they don't want to invest in anything that's new until it's proven. Now, Bitcoin is proven, but the ETFs are new. And generally, the firms want to make sure that these ETFs are big, I mean, really big in assets, that they're going to stay. The last thing a firm wants to do is have a client buy an ETF that then folds. So all you do is get your money back, and that just annoys everybody. So that wirehouses want to make sure that there's at least $100 million in each of these ETFs that they can handle the trading activity. And so it's not uncommon for a firm to say, we're going to wait a year or more before we add these to our platform. Well, these Bitcoin ETFs all hit billions of dollars within weeks. They blew past the 100 million requirement. Also, there's huge investor demand, and that's leading to huge advisor demand. So the wirehouses are all racing to get their due diligence and risk management research done, for the investment management team to choose which of the ETFs they want to put on their platform. Some are putting all of them, some are limiting it to just one or two or three. So they're racing to get it done. And they also realize they're competing with each other, because if one wirehouse does it, the other wirehouse looks silly by not doing it. So they're all competing in the marketplace. So I think that over the next few months, they're all going to be on board. And along the way, there's another piece, and that is advisor training. Remember, I said a lot of advisors don't know a lot about crypto. The firms have to make sure the advisors know what they're talking about. So they're busy getting their advisors educated. We're doing a lot of that with a lot of firms, because that's our big claim to fame here at DACFP is crypto education. We don't sell product. We don't manage money. We just provide content. And so a lot of firms are working with us to teach their advisors about what all this is, so that the advisors can talk intelligently to their clients.
Excellent. The second part is, do you think there'll ever come a point where these wirehouses will allow people to buy individual tokens rather than the ETFs. You think that day will ever happen?
Only when these tokens become securities, because Wall Street firms being regulated by FINRA and the SEC are limited to recommending securities. This is why you can't buy comic books from Goldman Sachs. You can't buy gold. You can buy a gold ETF because the ETF's a security, but you can't buy gold bullion from a broker. So if a security becomes available, then yes, it'll be listed by the wirehouse. Just like every stock, they're all securities. You can buy any stock at a brokerage firm. So Bitcoin, by the way, the SEC has already said is not a security. So you'll never see it traded by a brokerage firm. That's why Coinbase got created. Coinbase is a crypto exchange that trades crypto coins and tokens. They don't trade stocks because they're not a stock trading platform, but they're a crypto trading platform. So if you want to buy Bitcoin from a broker, you're going to have to do it through either an ETF or an SMA or some kind of accredited fund like a hedge fund or private equity or venture capital fund. But you're not going to be able to buy Bitcoin from Merrill Lynch.
Do you have an opinion on, let's take Ethereum, for example, buying Ethereum, the native coin, versus buying Ethereum, the ETF?
They're the same, with the exception of staking, as I mentioned earlier. If you want to engage in staking, then you cannot buy the ETF because you cannot stake the ETF shares. So, and staking is a big deal. I mean, a lot of people argue that over a 10-year period, they expect to make as much money from staking as they do from the price appreciation of ETH itself. So staking could potentially, over 10 years, double the value of your investment compared to holding Ethereum just by itself. It's the difference between holding a stock and a stock that pays dividends. So for that reason, staking's popular. About a third of all the Ethereum in the world is staked. So a lot of people engage in staking. Staking is risky. If something goes wrong in the staking pool, you lose all of your Ethereum. Your entire investment is wiped out. So staking is very risky. That's why only a third is staked. The other 2/3, people are like, I don't want to take the risk. So, so other than staking, there's no difference between buying Ethereum, say, at Coinbase, or buying Ethereum via the ETF. The only difference is the ease, the convenience, the cost of doing so, and so on. And the ETFs are easier, they're cheaper, they're more convenient. And this is why I believe in the future, most investors who aren't deep into crypto, they just want to have an allocation, they're going to do it through the ETFs, and I believe rightly so.
So that was actually one of the follow-on questions, was fees. And it sounds like you're saying, so if somebody asked the question of buying the native token, the cost of buying the token versus buying the fees, the ETF, that the ETF is.
Well, just look at Bitcoin, for example. I mean, we don't know what the fees are going to be on Ethereum ETFs yet because nobody's announced. I'll give you my guess in a moment. But look at Bitcoin ETFs. If you want to buy Bitcoin at Coinbase in an ordinary retail account, forget about the institutional accounts at Coinbase, which are cheaper. But if you're just a retail investor opening a Coinbase account, you're going to pay 1.5% to buy Bitcoin. And you're going to pay another 1.5% when you sell your Bitcoin. So 3% round trip, total commissions. The Bitcoin ETFs, the cheapest one is 19 basis points. And when you sell it, it's free. And a lot of these ETFs right now are 100% free because they've waived their expense ratio because they're trying to compete with each other and gain market share. So these things are so cheap. There's no reason to go to Coinbase, in my opinion, for most ordinary mere mortals who only want to buy Bitcoin. Now, the problem is all you do is get Bitcoin. If you want to buy other coins, Coinbase lets you buy dozens of coins. Can't do that with an ETF yet. So I think that the Ethereum ETFs are going to be equally cost competitive. I don't think they're going to be as cheap as the Bitcoin ETFs for two reasons. Number one, there was a huge price war among the Bitcoin ETF sponsors. The ETFs were brand new. They all came out of the gate at the same time. They were all anxious to capture market share, and they knew the only real way they could compete was on price. And the price war began, and it dropped all the way down to 19 basis points by Franklin Templeton, 20 basis points by Bitwise. Fidelity and BlackRock, I think, are 25 basis points. So they're all really cheap because they're competing with each other. But they're so cheap that, frankly, these guys aren't making much money. I mean, think about it. If you're earning 20 basis points on $1 billion, you're not talking about a lot of money at all, considering how much money you're spending to operate the thing. So I think they're all going to learn their lesson. I think they're discovering that, boy, these things are really popular. We really don't have to compete on price so much. So I don't think the price war will bring it all the way down to 20 bips. I could be wrong. I hope I'm wrong. I hope they do get that cheap for us as investors. But I think they'll probably settle more likely in the 30 to 40 to 50 range, 30, 40, 50 bips, rather than the 20, 25 bip range. We'll see. The price war may win out. Either way, even if they are as high as 30, 40 bips, that's still incredibly cheap compared to the alternative ways of buying it.
Yeah, yesterday Kathy Wood said she expects to make no money on their Bitcoin ETF. So there you go on the fees.
Yeah.
Next question. If you own Ethereum now, should you sell it and buy the Ethereum ETF once it's trading?
Yeah, that's the exact question Bitcoin investors had 5 months ago. You know, if you own Bitcoin, do you sell it to buy the Bitcoin ETF? And it's a good question. It's a tax question, quite frankly, because if you sell your Ethereum to buy the Ethereum ETF, you're going to incur a tax liability. So you got to keep that in mind. And here's what the annoying reason behind it. If you own shares of IBM and you decide that you would like to buy a stock ETF, you can send your IBM shares over to the fund provider as your investment without having to incur the capital gain. You can't do that with Bitcoin or Ethereum ETFs. The SEC won't allow it because the FCC won't allow the ETFs to custody crypto. So they won't let them hold the Bitcoin or the Ethereum as they fold it into their fund. They are only allowing cash settlements. This is, I think, a little dig by Gensler to annoy the crypto community and crypto investors because there's no legitimate reason to prohibit this, but that's a whole nother conversation. Bottom line is you're going to have to decide if you want to do it. I would argue yes. I did this with a little bit of my holdings, and I think that you could make an argument for this because I believe at the end of the day, the ETFs are safer than you holding crypto in your own wallet. You've got to control your private key. You have to safeguard it, manage it, protect it, make sure your heirs are aware of it. You can't easily manage it from an estate planning perspective. In most cases, you can't have a joint registration with your spouse, but you can do all those things with an ETF. So I think for most mere mortals, it's a more convenient, easier way. Now, there's an argument in the crypto community that not your keys, not your crypto, meaning that if you don't personally own the crypto and you're not personally managing your private keys, then you can't really call it yours. Somebody else really is the owner. And that's a good philosophical conversation for people deep into crypto. But for most mere mortals who simply want to say, I just want to add to my diversification. I just want to have a 1 or 2% allocation and call it a day. I don't want to become a crypto expert. I don't want to waste a lot of my time with it. Yeah, you could make a good argument for paying the tax. Look, you're going to pay the tax sooner or later anyway, right? Unless you die owning it, in which case, what's the point? So yeah, you might want to consider selling it and move over. Talk to your financial advisor, talk to your tax advisor, make sure you know exactly the implications of what you're doing, but it's worthy of consideration.
Once the ETH ETFs launch, would you do a lump sum investment or smaller dollar cost averaging?
That's for you to decide. I mean, it's always smartest to dollar cost average. We always know this. We also know that this asset class has prices that move very radically and through a lot of excitement. Look at the Bitcoin ETF experience. Bitcoin's price was around 40,000 before the launch and was very quickly 60,000 after the launch because of the incredible inflows of assets. People are expecting the same thing out of Ethereum. So it's up to you. Make a decision, make an informed decision, and stick with it. Don't try to second guess yourself or engage in Monday morning quarterbacking.
Gotcha. Here's an interesting allocation question. So this person has a portfolio of 2.5% Bitcoin ETFs. Once the Ethereum ETFs launch, they're thinking 2.5% with the Ethereum ETFs, but they also presently have 1% in the crypto picks and shovels ETFs. So does that mean they should dial back on the 2.5 and 2.5%?
Maybe if your total goal is to have 5% allocation to crypto, then I would consider the picks and shovels to be part of that allocation. So yeah, now some people may argue that the picks and shovels are different, that they're actually stocks and they're not crypto. I'm not sure I'd agree with that rationale, but I can understand it. So I personally, I would put crypto as the category, and then I would have all the different ways of buying crypto as part of that category. Coins directly, via the ETF, SMA, the futures funds, the picks and shovels, which is, you know, investing in stocks that are investing in the crypto community. I would put it all under the big umbrella of crypto. So if focus first on how much do you want to have in crypto, and then allocate within it as you're describing.
So I think it was yesterday, BlackRock announced that in some of their funds, they bought some Bitcoin. So I think that's probably where this question comes from. Do you think large cap growth and income funds will be allocating funds into digital asset ETFs as part of
No,
their?
I don't think so. I think that large cap limit themselves to stocks. I don't think that they're trying to get creative and move into other asset classes. And crypto is a different asset class. So no, I don't think they will. But what I do think is going to happen is that at some point, some people hope really soon, others aren't as sure, at some point, MicroStrategy will be added to the S&P 500. It meets pretty much all the criteria now. We're just waiting for the committee to say yes. MicroStrategy is the world's largest corporate owner of Bitcoin. They own 1% of the entire world supply. So owning MicroStrategy, a lot of people argue, is a pretty good proxy for owning Bitcoin. When Bitcoin gets added to the S&P 500, every large cap ETF will own MicroStrategy and therefore have an allocation of crypto. At Vision in Austin next week, we have a fireside chat with Michael Saylor. He's one of our keynotes. So I will be talking to Michael about that. And it's going to be a really fabulous conversation, a really good reason for you to come visit with us in Austin.
Great. Should tax reporting for crypto held in a broker account get easier now?
Oh, totally. Absolutely. For two reasons. Number one, when you buy Bitcoin at Coinbase or any other exchange, there's no 1099 issued. You're on your own for tax record keeping and reporting. That law that changes. The law has the crypto exchanges required to do this, I think, in 2026, but it's going to be a while. For now, you're on your own for tax record keeping and reporting. For a lot of ways you do this, such as a crypto SMA, you're going to get a K1. You're not going to get a 1099, when we all know how complicated those are. But this is an ETF, just like any other ETF. You buy it as part of your brokerage account along with the rest of your ETFs. And you get a 1099 at the end of the year. The brokerage account tracks your cost basis. It does all the heavy lifting for you. Simple, easy, clean, convenient. It's another big advantage of the ETFs and why so many advisors have said they're waiting for the ETFs to allocate to crypto, because all the cumbersome hassle factor goes away. It's wonderful.
Here's a little inside baseball question. Given the speed advantage that Solana has over Ethereum, do you believe ETH will have continued growth, or will Solana win?
Great question. Solana has been hugely successful. Its price has risen incredibly over the past couple of years and even the last several months. Solana, let's back up. Remember I said earlier that Bitcoin is slow. Ethereum is faster than Bitcoin, but Ethereum is still pretty slow. And that makes it not a good competitor to Visa and MasterCard. Solana was invented because it's a lot faster than Ethereum. Solana does pretty much the same thing as Ethereum. It actually sits on the Ethereum blockchain, but it is a whole lot faster. And this is why there's a lot of excitement about Solana. I'm a big fan of Solana. I own a lot of it. But still, it's Dr. Pepper compared to Coke and Pepsi, at least for now. And there's not going to be a Solana ETF anytime soon. So if you're going to own Solana, you got to do it the old-fashioned way. Go to Coinbase or Kraken or Gemini. I think we have time for one last question.
And the famous last question. What will the price of Ethereum go to by 2025, 2030?
Yeah. I can't give you a price prediction as effectively as I did for Bitcoin. You know, I produced a webinar that we released last month. You can watch it here at DACFP.com on why Bitcoin is going to hit $420,000. I'm actually going to be speaking on that at Vision next week. And I have a very simple set of math, arithmetic that explains why I believe by 2030, Bitcoin will be $420,000. There's the link to it that Mary Beth just put into the chat box, so you can watch the webinar for free. I can't give you a specific set of arithmetic for Ethereum for the simple reason that we don't know exactly how many Ethereum coins there are. How many ETH are there? We do know the count for Bitcoin, but I don't know the count for Ethereum, and it makes it more difficult. So I will simply say this. In the world of crypto, what we have seen for the past 15 years is that the rising tide lifts all boats. As Bitcoin's price has risen dramatically, so has Ethereum's and other coins as well. I believe that will continue. So if I am very bullish on Bitcoin with a 5x increase over the next 5 years, I think we will see something similar, perhaps even bigger, out of Ethereum. And with that, Don, I want to say thank you so much for sharing all that with us and helping me go through all the Q&A. I want to share just a couple of closing things with you right here before we go away. Number one is, as I mentioned, our new Spot Ethereum ETF toolkit. It's available to you right now. There's the QR code. Mary Beth also put the code in the chat box. We've got a lot of really cool info there for you, a video on what is Ethereum, a webinar, which is an encore of this presentation, a podcast I've done, a replay of my podcast on the Ethereum ETFs, and the grid, the comparative grid that lets you easily compare all the 8 different ETFs against each other. A lot of the info is still TBD. We're going to be increasing that as we go. Also, Vision. It's June 2 to 4, Sunday, Monday, Tuesday, Sunday in Austin. Get on the plane Saturday. We start Sunday morning, if you're new to crypto, with a 4-hour boot camp. If you're new to crypto, I'm teaching a 4-hour boot camp workshop. What is blockchain? What is Bitcoin? What is Ethereum? What's DeFi? What's the metaverse? What's tokenization? Fabulous content for 4 hours. And then the conference itself. Michael Saylor will be there. Chris Giancarlo, Crypto Dad, the former CFTC chair. We've got Catherine Molnar, who manages one of the country's largest pension plans, who's investing in Bitcoin. It's really going to be a great conference. I encourage you to attend. Also, now's the time for you to get your CBDA designation. Become certified in blockchain and digital assets. It is a professional designation listed by FINRA. Half the course, it's all online, self-study, take it at your own pace, 18 CE credits, but the first half of the course is all about the tech. The second half is the practice management, the investment thesis, portfolio construction, crypto taxation, understanding it enough to be able to explain to clients. This is the standard setter. Thousands of advisors have gone through the course from 37 countries. The course is actually in 9 languages. We have 5 different tracks. I encourage you to go through the course, and you can learn more through the QR code there. And of course, finally, my daily podcast covering crypto, longevity, exponential technologies, retirement security, so much more. Tune in wherever you get your podcasts. Don, thanks so much for helping me host this event today. I hope you all found it very of value. Let us know what information you need. We're here to deliver it to you at DACFP. I hope to see you in Austin on Sunday.